from here.
Would like your comments on three specific stocks, Mehraboon: Hindalco, Reliance Communications and Bharat Forge.
I think of the three, I would prefer the last mentioned first. But again, I think it's going to be a long haul, a long wait. I think valuations-wise, this definitely looks attractive, but the fact that the sector possibly has been given a very negative view the market has on this particular sector. So Bharat Forge, possibly I would rank it as one of the best possible companies in this particular segment in Asia. But at the present valuations, while it looks attractive, I don't think the stock is going to do too much in the short run. Coming back to the other two companies, possibly I would stay away from them even at the present valuations, because Hindalco or aluminium as a commodity is something which I am not frankly interested in. The equity dilution which the company is going to, increase right now because of the revised rights offer is again something which is a clear-cut no for me. Definitely the balance sheet is very interesting, but as a metal, I think aluminium is something which I would stay away from. Coming back to Reliance Communication, we continue to remain a little bit underweight on the telecom segment.
Right. What's your own assessment of the entire fertilizer and sugar pack? There are momentum plays, Mehraboon. Should retail investors be looking out there?
I wouldn't advise retail investors to look out at the fertilizer segment, number one, because as you rightly mentioned, Mini, is absolutely news-based, and it's something which not many among retail investors bother to understand or try to understand, and they normally end up buying the stocks when they have already discounted the good news, if any, which is going to come in the announcement, which have already come in the announcements. And this type of stocks normally give you the moments only 3 or 4 times a year, and normally investors catch them at the wrong side, at the wrong end. Coming back to sugar, I personally feel retail investors may end up losing their patience, and this is also a sector which depends a lot on what the government does. So if somebody is ready to wait for the long term, we have a positive view on sugar. When I'm saying long term, I really mean the long term. So, and allow me to state, in this particular market where investors are really bothered about the way the markets behave on a day-to-day basis, sugar possibly may not suit the appetite of most retail investors.
The other proxy to a certain degree about the rupee depreciation, Mehraboon, is the textile sector. More from a futures and options perspective, stocks like S. Kumar's, Alok Textiles have been reasonably active over the past couple of trading sessions. What's your own thought if you track any of these companies?
S. Kumar is an interesting story because there was something like which the market was talking about was the Reed and Taylor becoming a separate company and IPO coming. I don't think in this market conditions the management will do too many things on that particular front. But even otherwise, this remains an interesting story. But on the whole, the textile segment, Rahul, I think has got its own problems at the moment. And while the valuations in some of these cases may look very, very attractive, but I think they will remain attractive for some more months to come. So the problems are not going to be over for the textile segment in the very near future.
How do you play these other rupee-sensitive sectors? There is textiles, of course. There is even pharmaceuticals to a significantly large extent as well. How would you approach these two sectors? Not often spoken about. Of course, pharma is always spoken about as a defensive play. But the fact is, a lot of these companies have a very significant exposure to the US, and they do get the benefits of a depreciating rupee.
We have to see the trend, how it goes out. We are in the middle of August now. Half of the second quarter is already over. And if you are a bull on the dollar, then you'll probably be looking at buying both the sectors. But IT, it gets me back to the same thing that I've been saying, which is that is the core business outlook really going to be, is there a big turnaround there happening? Because whenever you come back to these issues, you have the whole thing of the kind of derivatives which they're in, and to that extent, what benefit will the bottom line actually see once the second quarter numbers come out? So,
can the top line growth for these technology companies come under a significant amount of pressure? Because if on one hand the US is continuing to go into a deeper and deeper credit crisis, and the situation today appears that it's a lot worse than what it was in the first quarter itself, because you have two of the biggest names that are being spoken about. Could it come to pass where the volume growth comes into question because of the significant exposure that they have to the financial services sector, and thereby you start looking at the guidance numbers again at the end of second quarter? Could that become a plausible argument?
There is a case for that, isn't it? If you are, say, someone like, a retailer out there in the US, and quite a few of the Indian tech companies have US retailers as the biggest client, and if you're in a slowdown, corporate tech spending is going to come under pressure. The issue is not a question of how much will you cut down on, it's in what manner will you cut down on. I think if you go back to the guidances given out by the tech companies in the last 2 consecutive quarters, fourth quarter and first quarter, all have, in both the quarters, all the companies have maintained a very cautious stance. The whole game on IT, which used to be there 2 or 3 years ago, that you put in an EPS number of 100, the guidance is at 98, during the year you upgrade it, and in the end you'll end up with a 110 rupees EPS number. That game is definitively over. The gap for overperformance is now gone. You just have to pick your bets as to which player, the larger it is, the better positioned it would be to ride out this storm. And there is a storm. I don't think there's too much of doubt about that.
And that possibly reflects on the fact that these stocks haven't run up quite a bit. Also, anybody who would bet on the rupee factor in the March lot would have been really disappointed, because many of these companies actually got the rupee completely wrong. They had huge MTM losses. Mehraboon, at the end of the day, we might sit here and analyze, but it really looks like a game of churn, like a game of roulette at this point, because every time you are bleak on the markets, the defensive like IT, the pharmaceuticals, etc. play up, but the volumes are abysmally low. What's your own sense in the direction as far as these markets are concerned? Is it going to be a value pickers market going forward, or do you think some kind of concerted move up could be possible here?
Well, I personally have stated that this market is going to provide lovely opportunities for traders. And when I'm saying traders, I'm not absolutely interested. I don't have any sympathy for this intraday traders. When I'm saying traders, I'm talking traders with deep pockets. I think this market is going to provide lovely opportunities. I think we are going to move in a range, and this range on the lower side, I think we are possibly reaching the climax. Again, I repeat the same thing what I have on stating, Mini. So I think it's a view which you need to take, and a view in which if you go right, I think you can go on increasing your positions. Like if at oil at 140, if you're thinking oil is going to drop, which not many amongst us were thinking that way, I think you could have possibly taken a position in some of the interest rate sensitives, and allow me to say the returns would have been phenomenal. And at the present level, if you feel oil is going to go below 100, take a look again at the interest rate sensitives, and possibly you'll end up making some money over the next 1.5, 2 months. So I think it's a view which I think every fund manager needs to take. The fact is we try to behave in line with the market, and many times we falter because we have started taking too short-term a perspective. So I think people with deep pockets, people who are ready to do the waiting game, I think this market is going to provide a lot of opportunities. And yes, volatility is here to stay. So I think people will do well to take trading calls and possibly move out if the stock ends up giving you a quick 10, 15, 20% returns. So I think trading is going to remain the flavor at least for the next few months. So volatility is here to stay, and people will have to take the sharp volatility in the industries.
Right, man. We'll leave it at that. Always a pleasure speaking with you. Thanks so much for joining in this morning. That's the view coming in from Centrum. Once again, wish you a very happy new year. Balaji Telefilms up 4.5%, cooled off from the highs of the day. 100 points down for the Sensex and Nifty down 28. Yet another day of outperformance at this point of time from the equity markets, given what our peers are doing. We'll take a break. When we come back, we've been discussing technology ad nauseum, courtesy what's been happening to the rupee. Krishna Kumar Natarajan, the CEO at Mindtree Consulting, will join us on the other side to tell us how business is shaping up for him. They have about a 60% exposure to the US market. Details on that and on the business fundamentals on the other side. Stay tuned.